Hello everyone, 16 years of providing housing loan and mortgage services. I'm Katsusekine, a financial planner. A concern when choosing a mortgage product is borrowing rate. This is a Mitsubishi UFJ mortgage with a variable interest rate of 0.525%. During the borrowing period, product that always subtract 1.95% from the standard store interest rate of 2.475%. This is a mortgage loan from Mitsubishi UFJ Bank, a fixed product for 3 years with an interest rate of 0.39%. There is no doubt that the lower the mortgage interest rate, the better. But it's 0.39% special for 3 years. Today, the fixed interest rate is 0.39% for 3 years, and the floating rate is 0.525%. I would like to explain which is the best. This is a floating interest rate. This is minus 1.95% a year from store interest rate to the end of payment is written. Subtracting 1.95% from the 2.475% current over the counter interest rate yields 0.525%. This is the interest rate that can actually be borrowed. And if the interest rate subsequently increases, it will be deducted 1.95% from the current over-the-counter interest rate. This is the explanation of the fixed interest rate. From the fourth year, 1.85% was subtracted from the interest rate displayed at that time. In other words, if the fixed period goes beyond 3 years and enters the fourth year, and the interest rate is changed to floating interest rate, 1.85% is deducted from the interest rate at that time, and borrowing interest rate becomes 0.625%. Here, we calculate when borrowing at the floating interest rate from the beginning and when switching to the floating interest rate after a fixed period of 3 years. First, floating interest rate. Borrowing is 30 million yen. Interest rate is 0.525%. Interest rate is increased by 0.5% every 10 years. Learn more about payment. The monthly repayment amount is about 78,000 yen. The interest portion is about 13,000 yen, and the principal portion is about 65,000 yen. And 11 years later, when interest rate rise, the repayment amount has increased from about 78,000 yen to about 83,000 yen, which is about 5,000 yen higher, and the interest part is doubled. The total interest is about 4.9 million yen. Next is fixed interest rate for 3 years. Similarly, if I borrow 30 million yen for 35 years, if I lower the interest rate to 0.39%, the monthly repayment amount is about 76,000 yen, which is about 1,700 yen cheaper than the floating interest rate. Interest rate will rise from the fourth year to 0.625%, and the monthly repayment amount will be about 76,000 yen to 79,000 yen. And here is the total interest amount, 5.3 million yen. The amount borrowed from the beginning with variable interest was 4.9 million yen. The 3-year fixed interest rate is cheap at first, but it will eventually be disadvantaged. Expenses will increase by 400,000 yen. There is no merit when considering the fixed interest rate for 3 years. But is there any merit in the 3-year fixed interest rate? There are several benefits. First, it's cheap. Secondly, it's overwhelming cheap at first, which is advantageous for those who can pay off in a short time.